This is Amit Kumar, and we'll discuss IS 8 accounting policies, changes in accounting estimates and errors. If I begin with IS 8 accounting policies, changes in accounting estimates, and correction of errors. So we need to remember three things in it. Mainly the definition of retrospective application and prospective application. So first we need to learn like how to decide an accounting policy. So we are deciding an accounting policy according to the standards issued by ISB. We follow the standards. The standards are issued by ISB on the basis of the framework. The framework defines assets, liabilities, equity, income, and expenses. And on the basis of the framework, they develop a standard, and that developed standard becomes the basis for choosing an accounting policy. Whosoever prepares financial statements on the basis of IFRS need to follow the guidelines as per given in the standard. But what if there is no issued standard? Like the standards get developed over time. There was no standard on agriculture, accounting for commercial rearing of animals or plants. There was no standard on share-based payments. The standard on exploration for and evaluation of mineral resources is being developed. The technology gets advanced, but the standards are following the technology later. What if there is no standard? Like, what is the basis? How the accounting will be done if there is no guidance given by ISB? What is the procedure? Can anyone throw light on it? Hello.
Sir, then we have to follow the industrial practice.
Industrial practice.
Industrial practice, and it should be consistent.
Or the other way around can be that suppose there is a standard on IS 16 property, plant and equipment, and by chance if the standard on intangible assets is not developed yet, so since more or less it is similar, we can look at a similar standard in the existing setup. If we are able to find an answer, if we do not find an answer, we can look at other national accountancy bodies around the world if they have given a standard on this. Like in India, we didn't have standard on agriculture or share-based payments earlier, but if we needed guidance, we could follow IFRS guidance and we could do preparation of financial statements. And if there is no guidance available anywhere in the world, then finally the industrial practice, because they have no choice, they can follow whatever is being done in the industry. And one more thing, we discussed that even if there is a standard which is issued, fair presentation can override the standard. If we are able to prove that our manner of presentation is fairer than what you are suggesting, we can override, but we need to substantiate it with a lot of information. We need to give a lot of disclosures that why we believe that the deviation from the standard is fairer, and there will be a emphasis of matter paragraph as well, also even highlighted by the auditor that these are the standards the client has deviated. So accounting policy is what? Accounting policy is principles, base, conventions used to show fairer presentation. The main idea behind IFRS is fairer presentation. If you're able to present fairly your financial statements, present fairly doesn't mean that it has to count to every penny. It doesn't has to be perfect. It's not. So there's a confusion always in accounting that we believe that it is mathematics, but it is not. The balance sheet may not match. There will be some amount which will remain as part of suspense accounts. There will be some amounts which we need to estimate. We cannot count it to every penny. So accounting policy is the base, rules, conventions which we need to use fairer presentation. What is an estimate? And why do we need an estimate? Anyone? Accounting policy can guide us, like IS 16 property, plant and equipment has two models, cost model or evaluation model. We can choose an accounting policy that we are going to follow cost model. In inventories, we have a choice that we can use either FIFO method or weighted average method, measurement basis. As I said, principles, base. So whether FIFO or weighted average is a base. Whether we are going to use FIFO as a measurement base or whether we are going to use weighted average as a measurement base. So if we choose one of them, we are choosing our accounting policy that will be following FIFO method of accounting, will not be following weighted average. And we may have to change as well. What we'll do if we have to change the accounting policy. Another thing is estimates. What is the need for estimates? What is the need for estimates? Why do we need to estimate something when we do not know the amount, what difference does it make to the fairer presentation aspect of financial statements? Estimates. Where do we estimate? We have estimates for bad debts. We have estimates for provisions, provision for warranties, provision for repairs, and then we compare it with the actuals. Why do we need them actually when we do not know how much money we are actually going to spend? Why can't we wait for the year to end and see how much money has actually been spent and then we record them? Why do we need to record this in the form of provisions and record a corresponding liability in the balance sheet? Anyone?
Because of approach.
Accrual system of accounting. Suppose we have given a warranty to someone, and from our past experience, there is an expectation that 20% of the people, 20% of the sales will return for repairs. And total cost of repairs for all the products sold could be, if everyone returns back, could be $100,000. So we know that from a past experience, if 20% of the people can return, we can create a provision for 20,000 of it, believing that 20,000 people may turn up. If we do not create a provision, we do not have any corresponding liability, we do not have any amount set aside in the balance sheet for meeting this obligation in future. Though this is not accurate, this is not perfect, at least some amount is set aside so that shareholders know that this amount is going to be spent on repairs or warranties or whatever we have obligated in terms of IAS 37 provisions, contingent assets and contingent liabilities talks about it, that if we have a present obligation as a result of past event from which future economic benefits are going to flow out to the entity, even if you are not aware of the amount, you need to estimate it. The estimate is still better because even if the actual amount is 19,000 or actual is 21,000, it is not going to make much of difference to the lives of shareholders in terms of feeling easy that the balance sheet showed differently, but suddenly there is an expense of 20,000. It will become very heavy for people to digest that the expense is too large. Why didn't they tell this in advance to us that this is the expense which we are going to bear in future? So provision gives clarity to the shareholder that these amounts may be deducted from your profits in future because these are our obligations as a result of past event. We do not know the amount. So there is an uncertainty. Either amount or timing is uncertain. But one thing is uncertain, we cannot avoid accounting. We cannot base our accounting on actuals. And that's what you said, accrual basis of accounting. So we need to create estimates to give fairer presentation so that the financial statements give a true and fair picture. It is not accurate, it is not perfect, it is not calculated to the nearest penny, but it is still able to include all the material items which can be useful for the shareholders to use this information. The third thing is errors. This is something which every management employee would like to avoid. So this standard deals with correction of them, correction of errors. Now, if we find that error which is belonging to the current period, we can immediately correct it. If we find an error which is belonging to the past year, since we are presenting comparative period, we can correct it in our comparative financial statements. But what if the error belongs to any period before that, but we discover it this year? How to correct an error which is belonging to periods which we are presenting today? We are presenting current year, we are presenting comparative, any period before that. So they are known as prior period errors. Prior period errors, because if I don't call it prior period means for the date, if it is 31st March 2019, we are preparing our current year balance sheet. The comparative will be of 31st March 2018. Beginning of earliest period presented is 1st April 2017. Now, if there is any error which belongs to period before 1st April 17 is known as prior period error and will be adjusted in this additional balance sheet. But if that error is belonging to the period from 1st April 17 to 18, we will correct it in the current year balance sheet which we are publishing along with in the comparative balance sheet which we are publishing along with the current year balance sheet. If there is an error which is belonging to the current year, which is automatically corrected in the current year. So the requirement is that if there is any change in accounting policy, or there is correction of prior period errors, we need to apply the effect retrospectively. What does it mean? Retrospective means as if we have been doing it since beginning. As if we have been following this accounting since beginning. In case of errors, we need to believe that as if the error never occurred. So the accounting treatment in case of correction of errors and change in accounting policy is same, that we need to apply the effect retrospectively. If there is a change in accounting estimate, we need to apply the effect prospectively. What does it mean? In the current year and in future years. We'll bring in the change in the current year and future years, will not go back to correct anything. Is the reason in IFRS 1, first time adoption of IFRS, the estimates are part of mandatory exemptions. IFRS 1, first time adoption of IFRS, these estimates are part of mandatory exemptions to apply retrospective effect. When the standard on IAS 8 says that if there is any change in accounting estimate, we need to apply the effect prospectively. If IFRS 1 was not existing, then we would have followed the same. But they have made it very clear again by writing it again in the IFRS 1, first time adoption of IFRS, that do not apply the effect retrospectively because it is an estimate. It is never done, the adjustment is never done retrospectively. So they've included it as part of mandatory exemptions, that please do not try to make any adjustment in the prior years. You have to apply the effect today and tomorrow, adjust the estimate according to the new cap, and do your accounting in the current year and in future years. What does it mean? How do we apply the effect retrospectively?